Thank you for joining us at XM.com for today's market comment by Haralambos Pissouros. I'm Maria Bashardez. The US dollar traded mixed on Wednesday, staying on the back foot against the euro, the pound, and the franc, but gaining against the yen. The greenback finished the day to close its opening levels against the risk-linked Aussie, Kiwi, and Loonie. The mixed performance of the US dollar may have reflected the mixed outcome of yesterday's PPI data for September. Both the headline and core rates came in better than expected, with the August prints being revised up, but the rate excluding food, energy, and transportation ticked down to 2.8% year over year from a downwardly revised 2.9%. This, combined with remarks by Fed Governor Christopher Waller, who echoed the latest dovish views of his colleagues, allowed the market to continue believing that the Fed is probably done raising interest rates. Currently, investors are assigning only a 28% probability for another 25 basis point hike by year-end, while they expect interest rates to end 2024 at 4.5%, which comes in high contrast to the 5.1% indicated by the Fed's latest dot plot. Most policymakers have been arguing that the latest surge in Treasury yields might negate the need for additional hikes, but Kashkari added that if high yields are due to expectations of what policymakers may do, they may need to satisfy those expectations. With yields pulling back this week following the latest Fed rhetoric, anything suggesting that inflation is stickier than previously thought may encourage investors to start reconsidering the likelihood of another rate increase before this tightening crusade ends. Ergo, the spotlight today is likely to turn to the US CPI numbers for September. Expectations are for both the headline and core rates to have slid, but considering the rally in oil prices during the month, the higher than expected headline and core PPI rates, and their upward revisions for August, the risks may be tilted to the upside. U.S. equities continued to march north yesterday, even as the conflict between Israel and Palestine continues to rage. Perhaps with the probability of another hike remaining low and several rate cuts being penciled in for next year, investors were tempted to increase their risk exposure. However, stock traders may get disappointed today if the CPI data point to stickier than expected inflation. In the energy market, oil prices fell more than 3% after Saudi Arabia eased fears of supply disruptions due to the conflict in the Middle East after it pledged to help stabilize the market. Thanks for watching today's market comment here at XM.com.